Good day, everyone. Thank you for joining us once again here at Seaford and Brew for our weekly briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to review over the first quarter GDP release that came out last week, and then look at the inflation numbers that came out on Monday morning. So let's look at the first quarter GDP. Came in at 2.3%, below where we were back in the fourth quarter of 2017 of 2.9, but it beat the estimates that the forecasters came out with of 2%. So that's a positive. We exceeded those expectations. So at 2.3%, let's look at the individual components in the growth quarter over quarter. Overall, personal consumption grew at 1.1%. This is a pull off from our growth rate of 4% back in the fourth quarter. In fact, even going back to the second quarter of 2014, we do not have a growth rate at or below that 1.1%. So that shows the significance of that pull off. And that came in primarily from the goods. Goods pulled off, actually detracted 1.1%. So we saw a contraction in there, and then we had the balance of the services kind of picked up 2.1% growth, which provided the overall 1.1% growth in that consumer segment. Now remember that consumer segment, that personal consumption expenditures, makes up 70 to 75% of GDP. On the gross domestic investment, we saw that pick up to 7.3% from where it was back in the fourth quarter at that 4.7%. So we saw a pretty good increase here, and that structures came in, increased 12.3% quarter over quarter. That's a very robust number, especially considering last quarter we were at 6.3. In the prior quarter, the third quarter of 2017, it was actually negative 7%. So we showed very good growth in that structures number, and that's a positive, because what we hope to see is now that we have that structures increasing, hopefully we can see a continual increase in the equipment to fill those new structures. On the residential side, however, we saw that grow at a 0% growth rate, so no growth rate on the residential fixed real estate, whereas last quarter we saw that come in at 12.8%. So a little bit of a pull off in the overall residential fixed investment. We anticipate that, though, to be revised and in the coming quarters to be positive again. Looking at the net exports imports, we saw exports increasing by 4.8%, and then imports increasing by 2.6%. Now that 2.6% for the imports, much lower than where we were last quarter, where we saw that growth rate of 14.1%. Looking at the government sector, we can see that grew by 1.2%. When we're talking about the contributions to the overall GDP growth rate, we saw consumer at that 73 basis points. Because of that slower growth rate, we pulled off from where we were last quarter at 275. So that's a pretty substantial pull off. But in the investments portion, we now are adding 119 basis points coming from that investments, government at 20 basis points, and then exports, imports at 20 basis points. So some positive movements in the investment and the exports, imports number. A little bit of a pull off, 30 basis points, 31 basis points in the government sector. Looking at inflation, though, we saw the inflation numbers come in. The PCE, straight PCE at the expectations of a 2%, and the core PCE at 1.9%, just below the consensus and just below the Fed's target of 2%. So we're going to continue to watch this core PCE. As you know, this is what the Fed kind of ties itself to in terms of inflation. So the higher this number gets, the more likely they are to continue their tightening strategy and potentially make that a little more aggressive. So we saw back in January at 1.5%, February at 1.6%, and now March at 1.9%. So we're starting to see this trend of continual increases in this overall growth rate. And that would point potentially to a more aggressive tightening strategy. But we still need to see these numbers continue to come out at a faster pace, above that 1.9%, 2%, getting into the low twos. That would kind of indicate that the Fed might continue or become more aggressive in their tightening strategy, potentially throwing in another increase in the Fed funds rate this year. But we're not there yet. We're going to see where we go over the next couple of months. That's what we have for you this week. We'll loop back with you next week as we cover the unemployment release or the jobs release on Friday, and then also cover the Fed's summary statement as they come out on Wednesday. Have a great week, everyone.